Welcome back to another episode of Rogue Wealth. Today, we're going to be talking about the tax code and mainly about starting to embrace the tax code rather than complain about it. Because the tax code, frankly, should be a part of your business plan and it could be your ATM. So let's start withdrawing all of the nuggets that the tax code provides. The core of this topic today really comes from my years of being an outsider of the tax situation and realizing that it's a coin toss when you catch your CPA or tax professional as a historian or when they're actually in strategy mode. Luckily, as a financial bodyguard, I've always had the luck of saying the entire full calendar is tax strategy and tax planning. And why is this topic so important for us as family business owners? We all have business partners, especially in family, spouses, kids, siblings, parents, and the IRS. Question is, guess which one takes the most and gives back the least? That's a problem if you take a passive approach with it. And with that CPA being a glorified historian so much of the time, you may be losing money at every corner. And as your business expands and unfolds, tax planning opportunities are missed because of that historian aspect and the next deadline that comes up. A lot of the business owners we run into really think the tax strategy and tax planning means being aggressive or being risky. I don't see it that way. I see it as being active and opportunistic. It's exactly what the tax industry wants you to think. They want you to be compliant so they can gather their documents, get through the deadline, and then move on to the next thing. And hence, there's a reason why you hear about people paying 15%, while you might feel like you're paying 40 or even more percent of your annual income and revenues, capital gains, and so on and so forth. And look, the tax code's overwhelming. The last time it was overhauled was somewhere in the 80s, back when I was a little kid. And we're not expected to read all 70,000 pages. But it's not 70,000 pages of restrictions. There are instructions on how to play the game and how to pay less. Just so many of us are reading it all wrong. And that brings us down to the competitor in our business down the street. While all of us might be competing on a better product, a better service, or better supply, or cheaper goods, the other competitor is doing the same, but they also have that tax strategy in place. And the difference, they're not fearing the tax code, they're embracing it. So today's episode's all about us leveraging it together. There's three things that nobody tells us about the tax code, particularly in the family business space. Number one, the tax code is a behavioral reward system. It's not a punishment manual. It's a system designed by Congress to tell us exactly what they want us to do and reward us with lower or no taxes. Okay? Family business in particular have superpowers that Fortune 500 companies would kill for. Okay? We hear about the Amazons and the Apples and their tax rates, but family businesses have this edge that just no one else can compete with. And three, your conservative CPA that you play around a golf with in the summer could be costing you more than Bernie Madoff ever could. And that's a big thing that we should take into consideration and address. Let's start with truth number one. The tax code isn't about taking your money. It's about directing your behavior and guiding you with deductions and credits and loopholes. That Congress basically is saying, do this, it will make you rich. They want you to buy equipment. Think about Section 179's immediate write-offs and bonus depreciation. They want you to hire family. I know this is crazy, but there's no payroll tax to your own children who are under the age of 18. Think about what you could do for them, setting them up with having them gain experience and exposure in the business, having them earn a wage while they learn, possibly opening up other tax planning, Roth deferral strategies that common folks just don't have access to. They want you to own real estate. They want you to depreciate real estate. They want you to exchange real estate. If you think about 1031 exchanges, you can defer capital gains and continue to upgrade and expand and make your business bigger and more complex. Congress wants us to provide benefits for our staff and our employees. Those are all deductible. They also create an entire space in the tax code, and it could be for old school manufacturing to really up and coming software and technology companies. You can even separate intellectual property, regardless of the type of business you are, because the things you do are unique to your business. Could be your logos, it could be your client and customer lists, it could be your processes and systems and procedures. The government and Congress wants us to separate those into a different company, charge royalties to unlock value in your business and generate additional income. Look, the government wrote us this 70,000 page business direction plan. Okay? While our competitors complaining about taxes, and our friends are too, particularly around those tax time years, we should just follow those instructions. And every tax break is the government begging us to do something or directing us to do something. And they literally pay us through a lower or a deferred tax bill. And we just can't sit there and rely on our CPA around tax deadlines to make an informed direction and strategy. This requires a mindset shift. And you got to stop seeing the IRS as the enemy. Just embrace them. They are there for a very important function. Start looking at the tax code as a treasure map. And every section provides a wealth building opportunity. And Congress wants us to use these strategies. They were written for us business owners, particularly the family business owners. 2, the family business advantage. Literally, our kids, they're walking tax deductions. Okay? It's so interesting. If you look at it, the tax code was specifically designed to reward family-run businesses. Congress wants American businesses, not government dependence. Congress wants American businesses to thrive and flourish because of the strength and sense of community and the engine that family businesses provide all over the country. We could go well beyond the country and look at it globally, but we're talking about where we are right here at home. Family businesses statistically create more jobs, they last longer, and they stabilize communities through charity, through events, through caring for one another and providing for one another. And so the rules are totally different for us as family businesses than for an Amazon or Apple or any of the Fortune 500. And here's what the Fortune 500s can't do. They can't hire your teenage kids legitimately and pay zero payroll tax. That's illegal for them. Your children working in your business can earn thousands of dollars tax-free. You get the full tax deduction. They don't have to worry about Social Security and Medicare taxes up until the age of 18. And there's $5,000, $6,000, $7,000 a year of pure tax savings per year. Again, it's legitimate work. Okay, they got to show up, they got to do it. But it's a leverage tool that other businesses simply can't do. Another piece that you could consider, you can rent your home to your business. You can search this up. It's called the Augusta Rule. But if you think about off-sites and senior leadership meetings and management meetings and strategy meetings, whatever your cadence and whatever you call it, off-sites can be done and hosted at your home. You get to go up to 14 days a year, and that's all tax-free income to you and deductible to the business. So imagine it's $1,000 a day. That's $14,000 of tax-free income that you're getting that the business is deducting. Again, another thing that most of the businesses wish they could but can't do. Thirdly, you can split the business amongst your family members and then leverage different tax brackets for different participants, bringing in massive estate and succession planning techniques, all while the kids get involved and get to learn what the business does and how you can help build wealth for them and solidify that generational wealth that others just don't have access to. It's amazing how many things a family business can do from a standpoint of the tax code. Third, the strategies your CPA forgets to mention. And I got so many wonderful CPA friends and relationships I've built over the years. This is not their fault. This is a function of their business and the tax deadline world they live in. 1, if you think about your grandparents, my grandparents, and the time when America had these rich pension plans, huge pension plans, the fastest growing pension plan segment that actually exists are in privately held and family-owned businesses. you got to forget about the whole 401k limit. Okay, that's small bean stuff. Cash balance and defined benefit plans allow participants, the family members of a business, to put in 80, 120, well over $200,000 per year of income deferred into a plan. And you can do that year after year after year. It's the same tax code. It's just different knowledge. Okay. Forget about the 401k. That's just table stakes for everyone else. Family-run businesses can fuel it up with pension plans that CPAs, frankly, just don't think about because it's a little more administrative work behind the scenes. Once you have it in place, it runs really well. There's so many other government incentivized gold mines. One I'll share with you here, solar panels and energy tax credits, which, by the way, will be phasing out as this episode rolls out. But that's not the point. The point is that the tax code is a living and breathing thing. Every time Congress meets, there's a changing in the House or the Senate or a president, different incentives and different motivations come up. And so it's important to make tax planning and strategy a regular, consistent part of your business planning. Cost segregation on your building. You can take 39 years of depreciation and cut it down into 5 years. So if you've got a $2 million building with a proper cost segregation study, you can literally make $600,000 of write-offs in 1 year. Just put the math to it. Think about the impact and the influence that you can have on a proper tax strategy. You can make massive immediate tax savings. Opportunity zones allow for deferral of capital gains well into this decade, potentially further out into the 2030s. At some point, depending on if you follow the rule of the law, which is important, but if you do the work and your team does the work around you, you can pay zero tax on capital gains and appreciation, helping turning neighborhoods that are underfunded and had been forgotten into tax-free fortunes and fueling growth and incentivizing growth in those communities. Rogue wealth rule number 4. This one's important. If you are questioning the value of something or someone, and it might be a professional relationship, or it might be a piece of software, or it might be something on your balance sheet, it's probably already too late. You already know the answer to that. It's already costing you way too much money than it's providing you value. And I would strongly suggest you fire or remove or replace that thing that you're questioning and replace it with something that brings you more value, more peace, more time, whatever it is that's important to you. It's not worth the administrative paperwork and burden and stress in business. I'll tell you about a story here, and this one's fun. A story about 2 brothers, okay? 2 brothers just before the great financial crisis. Dad was running a nice little distribution and logistics business, and he got sick. He got pretty ill, and he said that I've got to get out of this business. The timing of the market was such that it would have been a fire sale for the business, and it would have absolutely devastated the family. And so the 2 brothers actually took over the business and carved it up amongst themselves. They both had separate tax people and professionals involved. Brother 1 kept the LLC of the business and that structure, and his CPA and his team said, hey, you know what? C corporations are messy. You got to pay tax twice. It doesn't make any sense. Let's just keep things as they are. He ended up selling that business for $25 million. He paid somewhere around $6 million in capital gains. He walked away with 19. All right. Hey, that's not a bad day. But it doesn't help when you learn about brother 2. Okay? Brother 2 went a totally different path. He converted his business into a C corporation. He did it with all the documentation, the proper filings, and gave it enough time. You have to give it at least 5 years. But he qualified for the small business stock ruling, sold that same business for the same amount of money as brother 1, $25 million. His federal tax liability was 0. So he walked away with $25 million. It was one conversation about corporate structure, some serious planning, one form filed 5 years ago, $6 million of a difference in terminal value. That's a huge number. So big that brother number one and his CPA still say they erred on the side of conservative advice. They didn't want to rock the boat. Brother two, he keeps sending out Christmas cards from his travels around the world to myself and his tax team saying, thank you, appreciate for everything that you guys have done. And the tax code explicitly allows exactly what brother number two did. Federal tax-free gains from qualified small business stock. It's not a loophole. It's not aggressive. It's written by Congress to reward entrepreneurs and to incentivize them to create jobs, to buy businesses, to support the community, payroll taxes, Medicare, Social Security, everything that happens that an entrepreneur creates down the channel, all just to say, hey, if you do some extra work with your team, you don't have to pay any federal income tax if you sell, and you fit within this box. You have to structure it correctly and follow each and every step. I know it requires work, but that's the whole point of this episode, is just to say the awareness, to pay attention to all of this, because you can have an exit that's either 100% taxable or 100% tax-free. And the only difference is whether or not you know about the proper sections and the proper pieces of the code. So here are a couple of tax-free takeaways in all of this episode that we've talked about so far. Number one, stop being a tax victim. Start being a tax strategist. Leverage your team or build the team around you to have that same perspective. Add the tax code to your business planning process while you're doing it at your home with your team. Every strategy in the book is legal and encouraged. It requires documentation and discipline. And I think that's where a lot of the majority of people get caught up in it. Fade that. Congress wants you to use these tools, and that's why they created them. Two, your family business has these massive superpowers. Why wouldn't you use them? Your kids are tax shelters that call you daddy or mommy. And your spouse is a six-figure deduction that sleeps right next to you. That spouse carries the burden with you, hears about it, asks about it, and you can bring the spouse into the business and do it together and leverage the tax code to that advantage. The business structure determines your tax rate. Is it 40 or is it 15? Is it too much or is it just enough? That's up to you and your tax strategies. And three, reassess your professional team, your CPA, your tax advisor, your tax planners, maybe your estate and succession planning, your exit planners, and everybody else. Ask questions. Hey, what's my effective tax rate? What's the proper structure and organization that we should have given where the business is today? Are there things that we should be doing, or are there ways to involve our family members into the business given where it is today? What should we expect with the new tax code? What should we be looking for? There's so many different questions you can ask and just put part of the checklist on an annual regular cadence and make it part of your process. In closing, here's your Rogue Wealth Challenge. Stop accepting mediocrity. Don't accept average. It sucks. Know that you have three choices. One, stay complacent. Keep your current CPA, keep paying 40% in taxes, wondering where your money is at, be miserable come April 15th, and die working while the IRS thanks you for funding their budget. And I only giggle because they don't say thanks. You'll never get a thank you card or a nice little pen. It's a cold, hard check that you send one way with no attention on the way back in. Two, get curious. Schedule a Rogue Wealth session with me. We can take a look back at your last 3 years of returns, and I bet you we can identify thousands to tens of thousands of dollars in savings you're missing. It's a 1-hour conversation that could change the trajectory of your family's financial future forever. And we're happy to collaborate with your existing team and catch them when they're not in history mode. We're also happy to introduce you to a team of professionals that will care for you going forward. 3, get active. Become strategic. Comment below with your biggest tax pain point, and we'll do deep dives on a future episode on that specific strategy. Do you want to learn about captive insurance? Do you want to learn about dynasty trusts? Do you want to know about QSST trusts and opportunity zones? You tell me. We'll expose it, and we'll get the professionals that specialize in those tools to tell you all about it. The tax code is either your prison or your palace. The strategies exist, the laws are written, the wealth is waiting. It's up to you to decide what's best for you and your family.